Good morning. It is Monday, March 31st, 2025. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Managed ETF Portfolios. This is my weekly economic and market commentary for the week beginning today. As a reminder, if I have some commentary intra-week, I will post it on LinkedIn. Please follow me there, Herb Morgan, or on X, that's at Herb W. Morgan. This presentation, of course, is designed for both financial advisors and individual investors, but each are expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice. There are no recommendations for the purchase or sale of any securities. It's all purely for informational purposes only. Accuracy, adequacy, completeness cannot be assured. The views expressed are mine and mine alone, may differ from CFIA's parent affiliates or other portfolio managers here at the firm. Well, we continued with another down week in equity prices, and we've definitely are now retesting those lows. S&P down about 10, NASDAQ Composite down about 15, Magnificent 7 down about 20. We had rallied off the back of hitting those from a technical correction, and now we're right back down to testing those. As I've been saying for about 4 months, I think we got a little bit further to go on the downside as we adjust and adapt to the new economic reality and the remaking of the American economy away from over-reliance on fiscal and monetary stimulus, and instead an economy that relies on capital investment, both foreign and domestic. That is what the tariff situation is about. It is about encouraging additional capital investment in the United States. When this quarter ends, shortly thereafter, we'll find out how the foreign direct investment was in Q1. I don't expect big things, but this is a change, and the market is adapting and reacting to a new reality, which in the long run, I believe, will likely be good for our portfolios. Okay, after the sea of red, we got data. We start with manufacturing. The flash reading from S&P Global on U.S. manufacturing fell below 50. Remember, we had that little trend of upward months. We got down, unfortunately, just a tad below 49.8, well below expectations. The respondents to the survey cited rising material costs. This inflation thing is not going away. Remember last month we had a good PPI report and everybody thought, oh, wow, this is great. Maybe the Fed can cut interest rates. No. The inflation data is actually getting worse. Sentiment, also just declining sentiment, caused a decline just barely below 50. Well, hopefully it's just 1 month. We'll see what happens. We also got the flash reading on the services sector. That was a great number. S&P Global Services PMI rose from 51 to 54.3, well above the estimate of 51. However, on this inflation theme, input prices continue to rise to the highest level since September of 23. It's the highest reading, in other words, the rate of increase. So to say that inflation was transitory, we now know it wasn't. And to say that it's really making progress, this is sort of proof that it's not, unfortunately. Expectations also of the respondents to this survey fell at the lowest level just since last September. Lots of data on residential real estate prices. FHFA House Price Index rose 0.2%. That was a little bit less than expectation, but 4.8% on a year-over-year basis. Housing inflation is still very high. If you already own the home, of course, we're happy about this. If you or your children or grandchildren are trying to buy a first-time home, particularly in a market like Southern California, it seems almost insurmountable. And if you're in the industry of selling and buying homes or building homes or decorating homes or insuring homes, things are particularly challenging. And business, of course, as we know, is slow. S&P Case-Shiller Home Price Index also rose. Estimate of 0.4 came in at 0.46, also up 4.7 on a year-over-year basis, about the same, very close to the same as the FHFA number. New home sales continue to be very low, right? If we have a housing shortage, we have high prices, but unfortunately we have high interest rates. Prices for building homes are high, expecting to go higher as inputs to production that are imported are expected to be tariffed. No real end in sight anytime soon on the home front. But the pace is 676,000. We need a pace closer to about 1 million new homes per year. Pending home sales rose a little bit, 2%. They had declined in January, so they had see the December and January numbers declining there, so it was kind of a rebound. Most of that was weather related. Overall, the year-over-year number for pending home sales is down 7%, and a year ago things really weren't that good. So this is not a very good or healthy number. Then we get into the really bad stuff, and that is confidence surveys. So you're going to hear, if you haven't already, a lot of discussion about soft data. One of my golf partners asked me about soft data over the weekend. He's in a hard industry, he's in the building industry, but he was talking about, hey, what about all this soft data? And this is true. The soft data is really rolling over, but it's soft data. It hasn't yet rolled into the hard data. The question is, will it? You saw the services sector was strong. You saw manufacturing was pretty strong, although it did dip below 50. But the soft data is people are getting worried. They're getting worried because they see market volatility. They're getting worried because inflation's not coming down. Housing affordability is very, very challenging. And there is massive amounts of uncertainty related to trade. We've got a big deadline for the implementation of reciprocal tariffs that is this week. And we really don't know what will or will not be implemented. So let's start with consumer confidence from the Conference Board. Fell from 100.1 to a 4-year low. You can see it over here on the right, 92.9. That was below expectations. Present situation fell from 138 to 134. Expectations dropped to a 12-year low of 65.2. So people do not have confidence. That's driving market volatility and markets lower. Typically, when you get below 80, and we're well below 80, you can often associate that with a recession. I am not ready to call that. The labor market's still just too strong. The service sector is still too strong. I think the sentiment is being hit by just sort of the political reality and the discourse of this change of relying constantly on fiscal and monetary stimulus. Michigan sentiment did the same thing as Conference Board sentiment. It rolled off a cliff, went from 64.7 to 57.0. Not good. Current conditions fell. Expectations fell as well. Again, soft data. This is how do you feel. This is not a number that measures an actual amount of production or an actual amount of GDP. So they're important, but they're not tell-all yet. Not yet. They could be. Let's go on. I also noticed that during this year, a lot of sentiment reading. I'm just going to put three together. Actually, Bloomberg did this. It was a great chart, so I grabbed it this morning. People in the business conditions survey said that things were getting, if you take this, the delta between better and worse, just overall, is it things getting better or getting worse? If the number goes negative, that means more respondents say they're getting worse. It's gone negative. You can see that, the white line. Same thing with employment. Are there more jobs available or less jobs available? Now, that's different from what we heard in the JOLTS survey, but these are sentiment surveys, so softer data. That's certainly not a positive. And are people's expectations about their income increasing or decreasing? Right there at the zero line, you can see it right there. Not particularly encouraged bit of data. Let's move on to durable goods orders. They actually gained 0.9%, on top of a sizable gain in January. That's good. We'll take it. Back out transportation still up 0.7%, so a solid reading there. And as I keep saying, weekly jobs claims are the best real-time, fastest indicator. You should get them every single week. A delay, obviously, but a week ago, the 225,000 for initial claims for unemployment. That's a really, really low number for an economy the size of the U.S. So the jobs market remains strong. If the jobs market remains strong, the consumer will remain strong. If the consumer remains strong, earnings are going to be just fine. We also got fourth quarter GDP. The initial reading was 2.3%. It got revised higher to 2.4%, and that's on top of the 3.1% gain in the third quarter. Now remember, the third quarter of last year was a presidential election quarter, or excuse me, the election was in the fourth, but the reporting of it was in the fourth. The third quarter was reported in the fourth quarter. As you know, that always seems to happen as incumbents in office, all parties, push out government funding for projects and contracts to the extent that they can really juice up the data. Then you usually have it roll off not in the fourth, but in the first quarter, the quarter we're in now. So I expect some softness there because, all that money had got pushed out. Real GDP grew 2.8% of all of last year on top of 2.9 in 23. Two great years. Two great years for the equity markets, both up north of 20%. Personal consumption was strong at 4, revised a little bit lower. Net exports, government spending, and business investment all revised a little bit higher. So it was a solid GDP number, really solid. So this is why I talk about hard data versus soft, right? The hard data is still good. Soft data is turning lower. The question is, will the soft data pull the hard data down lower? More hard data, personal income. Personal income up 0.8%, doubling the expectation in February. That was solid. Personal spending up 0.4%. So also solid. But here's the bad news. I keep talking about this inflation situation. And Fed's in a hard place, right? They cut interest rates several times last year without inflation being a target because they wanted to get ahead of it and prevent job losses. They saw some softening things happening, maybe. February PCE price index and core PCE price index were up 0.3 and 0.4 respectively. Core, the one that matters, this is the one that determines whether or not the Fed is meeting its statutory mandate of price stability, was worse than expectations, 0.4 versus 0.3 and 2.8 year over year. That's also worse than expectations. The goal is 2. And as you can see here on the right, we stopped going down almost a year ago. In fact, you say, 4 or 5 months ago, we started going back up with inflation. And what happened to inflation expectations? To me, you've heard me say this, the most efficient market in the world is the U.S. Treasury market. It is the largest, it's the deepest, it has the most players. Therefore, it's an amalgamation of the greatest number of minds, thoughts, views of the world. And therefore, what it tells us is something we should take seriously. The break-evens, which is the nominal yield minus the tip yield, or Treasury inflation protected security yield, says this is what the market of Treasury investors, which is massive, believes inflation will be over the next 2 years, 5 years, and 10 years. And over the next 2 years, you go way back here to September, not that long ago, we were saying 2-year inflation was going to run about 1.5%. Now the market believes 2-year inflation is more than double that, 3.3%. It's an absolutely massive increase. Now, to be fair, 2 years is a short period. It will be more elastic. Let's take a look at the 5-year. We're at 2.7, well above the Fed's target, of 2. We were at 2 back in September. The 10-year number, which is a slower moving number, also been on the rise, up from around 2 in September to about 2.40. So nothing particularly good on the inflation front. The Fed can't cut interest rates with inflation rising and being above target. The Fed can't go out and start purchasing mortgage-backed securities or U.S. Treasuries. They are redeeming less on a monthly basis. We call that a baby cut. And you can't go for more deficit-financed fiscal spending because that causes inflationary pressure. So we're trying to remake the U.S. economy, and that's the volatility you're seeing in the marketplace. Lots of economic data this week. Start with Chicago PMI this morning. The final numbers on S&P Global and ISM manufacturing as well as services come this week. Construction spending, job openings, JOLTS, auto sales, ADP employment, the big BLS, Bureau of Labor Statistics employment report, all of that. February trade deficit, that'll be big. Expected, probably another surge in imports ahead of expected tariffs. Thanks everybody for tuning in. We are available on all the audio podcast formats, but if you want the video with the graphs, don't worry. No video of me, just the video of the graphs. We're on the YouTube. It's called Slaying Bulls and Bears. Try to make the complex and complicated simple and sensical. I thank you for tuning in. I'll be back to you again a week from